The bank problems, they're not over, unfortunately. Different banking problems, but banking problems nonetheless. The story
Right.
this week comes out of New York Community Bank Corp, which is the latest U.S. bank to be facing troubles. On Thursday last week, the bank said they lost 7% of its deposits in February alone. Deposits dropping from $83 billion at the beginning of February to $77.2 billion at the end of February, which is obviously a considerable decline, almost a 10% drop in deposits in a single month. And this is the troubles for this particular bank, New York Community Bank, really kind of started back in January. So in January, they reported their Q4 earnings, and essentially they saw a massive swing of profitability from $207 million in Q3 to a loss of $252 million in Q4. So a swing of like $400 million just in a single quarter. And it was the first loss that they've had for the bank since 2015. So it was a pretty significantly bad earnings. It was the stock was down 60% in a day or something, an enormous decline in the stock. And it really comes. Not only did they report a significant loss, the why they had the loss is also really interesting. So primarily, the bank's facing the likelihood of higher than expected losses from its commercial real estate segment, which is a very large part of the bank. Particularly in office space real estate, they're expecting larger defaults than previously expected, and that kind of plays into the main reason why they reported such a significant loss and why the stock fell 60%, as they're kind of projecting forward now that they're expecting much bigger losses. And this is kind of an interesting, it's like 1 point of data in, or maybe like the first domino we're seeing in a much larger office real estate problem that's been going on, or that's starting to kind of evolve in the US, where essentially you've got a lot of office buildings being refinanced into much higher interest rates. That, is same as we've kind of seen in some parts of residential real estate, especially in Australia. You had kind of these low interest rate loans go out during COVID. And for commercial real estate, the loans are a little bit longer, 4, 5, 6 years. So we're just now seeing the refinancing of those loans. And it also comes at a very unique time while there is just a persistent decline in demand for office space real estate because of this kind of hybrid work from home, new kind of work culture that's come out of COVID. So it's a really fascinating kind of situation where you've got higher costs coming in for property owners of office spaces and potentially just a secular decline in demand for offices. Like there could just be a permanent decline in the need for office space, particularly in expensive metropolitan cities where people may prefer to live a little bit further out of the city and do a hybrid work option rather than having to commute and be in the office every single day. So,
yeah, and it's getting so bad that like the Blackstones and the Brookfields, I was reading some article, and Steve Eisman's spoken about this as well. The Blackstones and the Brookfields, instead of bothering to go another round and refinance at, firstly, because the values have dropped, they have to put up more equity. And then on top of that, the interest rates are higher, so they have to commit themselves to a worse cash flow situation from each property. So these big real estate investment companies, instead of like going another round and refinancing, they're literally just walking away.
yeah.
They just walk straight back to the bank and they go, here's the keys to this office building. We don't want it anymore. And then ultimately, I mean, boohoo, that's bad for the Blackstones and the Brookfields, but it's bad for the banks because ultimately, like, who owns the real estate? The banks own the real estate because the banks give them the loans. So yeah, it is a cash flow problem, and a lot of commercial real estate loans need to be renegotiated over the next few years. I do believe so. It's particularly the office real estate, isn't it?
Yeah, I think there's problems in all kind of parts of commercial real estate, but office real estate is the most egregious.
Because of what you're just talking about.
Yeah, because of this kind of potentially just permanent secular decline in demand for office space.
Mm.
So it seems like, yeah, New York Community Bank is kind of just one of the first big examples of a company, of a bank coming out and saying, yeah, we're starting to feel the effects of this, and it's likely going to be a problem for us for the foreseeable future. Back in January, they slashed their dividend as well. So the dividend before all of this kind of came out was 17 cents per share. In January, they cut it to 5 cents per share. And then last week, they cut it from 5 cents to 1 cent. So they've gone from 17 cents to 1 cent, which is effectively zero. They can, I don't know why they left the 1 cent there. They could have just called it a day and,
Yeah.
and say, you know what,
No, no,
we're
no.
done.
We still pay a dividend.
Yeah, it's like the next cut's going to be, well, now we're going to pay 0.5 cent.
Yeah.
We're still paying a dividend.
Just pay a cent so that when the CEO just gets asked by random, oh, you guys still pay that dividend, right? And you'd be like,
Yeah.
oh, yeah.
Yeah, unbroken streak of dividend. Like they want to be able to put that in the press conference of their quarterly earnings.
Yeah, consistent dividend payer since 19 whatever.
Yeah. We did cut it 99.9999%, but we paid it.
We have paid a dividend every single year for our shareholders.
Yeah, pretty much.
Yeah.
So yeah, I mean the story around why their deposits did see that 7% decline is likely a direct result as well, not only of all this commercial banking stuff going on, but because of what happened after their earnings, which was the ratings agency Moody's cut their credit rating to junk quality. So, yeah, it's obviously not good at all, and that seems to have been a catalyst because the next day was kind of the first day that the deposits started to accelerate and decline, down 7% in the last month. Incoming CEO Joseph Otting told analysts Thursday that the bank would look to strengthen its capital and liquidity levels and reduce its concentration in commercial real estate loans. They also announced a $1 billion capital injection from a couple of investors.
That's right. Yeah, they raised $1 billion. Yeah.
Yeah. So, and I think, I think not only that, but it's also important to realize that, this is a very different situation to SVB and the banking crisis that was going on on last year. Most of the deposits are FDIC insured at NYCB. So it is a completely different situation. That was kind of a Silicon Valley based VC kind of bank that had a very concentrated number of clients and customers that were not insured. So a bank run was they were very exposed to a bank run. This is a very different situation. It's more as if they're very likely going to be facing significant commercial real estate stress, but a bank run is unlikely, although it's not impossible that people still kind of panic.
Yep. Yeah, it is a tough time for commercial real estate and office real estate. The one interesting thing which I saw, Jerome Powell did a testimony like last week. He testified in front of, I don't know, the House Banking Committee or something, blah, 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 some name like that. And I guess one positive is that one of their focuses right now is commercial real estate, particularly. And he said, like, he spoke as though he knew exactly what's going on. Like, he knows the office real estate is particularly the main risk factor, and the Federal Reserve is actually working with the banks that are most at risk. He notes that the big banks in America are not at risk from this issue. It's really small pockets of regional banks. He did say that there will be some failures. That's his best guess. It will be the smaller regional banks that might fail. The Federal Reserve is working with each one of them that's at a high risk to develop a plan to get them through if they can. The other thing he said is that his current estimate is that it will be a whack-a-mole situation as opposed to a domino situation. So as opposed to one thing causing problems for the next, and you get a domino effect, a banking crisis, he thinks it's more going to be isolated incidents here and there of regional banks popping up that will face problems as opposed to a systemic issue. But yeah, very interesting what's going on in commercial real estate, isn't it?
Yeah, it's exactly right. I mean, office it is a big market. It's, it's hundreds of billions of dollars, but office space real estate is a very, very tiny piece of like the overall US real estate market, which is obviously mostly residential. And then even within commercial, office is one of the smaller components. So while it's still a big issue, especially for some of these banks that are, as you said, regional banks that aren't that big, and maybe they have big exposure to office space. On like an economic scale, it is going to be probably an isolated kind of incident.
Yeah, people flinch really easily when they hear about real estate crisis, don't they?
Yeah,
After
like, oh, not
2008,
again.
but yeah,